AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us today. What's the date today? 25th?
Last day of February. 2 months in already, believe it or not.
Last show of February.
Last day of February coming up.
Of course it's coming up. This is the last day of March is coming up.
No, the first day of March is coming up.
First.
Yes, sir.
All right. We got it all straight now. It's Thursday. We are live. You're welcome to call the show 800-516-1220, 800-516-1220. We are streaming as well at kdow.biz. If you jump out of your car. I know this show doesn't reach everywhere, so you can always go to our podcast at BayAreaLoanSource.com. I greatly appreciate that. And all the emails that we get, you can shoot an email, Tony@BayAreaLoanSource.com. We're going to start off by talking about rates. It's been the story last year, Gordon, as it just, right when the pandemic started. We went into this kind of mini recession, rates went down. It took a while for the 10-year yield to catch up to really where rates were. Now they did about 2 weeks ago, and they're starting to bump back up, and rates are following. Mortgage rates, that is. So we've seen the 10-year Treasury hit 1.45% yield, first time since 2020 in February, so about a year ago. It's back to where it was. The Federal Reserve basically is, they're saying that it seems pretty clear to us that the move in rates has been driven by growing optimism about economic growth, and rates are finally catching up to the bullish growth outlook in equities. A USBS strategist said that with the pandemic winding down later this year, massive pent-up consumer demand, more fiscal stimulus on the way, and the Fed keeping the pedal to the metal, it's hard to see the recent rise in rates having a material drag on economic growth. So, if you think higher rates is going to hurt the economy, they don't, which means that higher rates might be here to stay a little bit longer than we thought and a little bit sooner than we thought.
There were a lot of concern. Anytime rates start to go up, there's always a concern. What we call the panic people that have been sitting on the sidelines waiting for rates to go lower than where they were. Lots of calls today, want to know where is my lock, when can I extend. It's a very, very difficult time to maneuver and negotiate when rates are on an upward trend. Lenders or investors aren't willing to give up anything. So a lot of times it is what it is. It's an unfortunate statement, but that is the reality of what we have to deal with when we are in the rate game. That's why I don't like to play the rate game. I always like to tell people when you get a rate that satisfies your condition, take it rather than sitting on the fence waiting for it to actually go down. But now we're just seeing rates go up. We're getting all those calls and we're trying to work through it. The federal government feels that now the good time to rebalance the economy. We're spending all this money on stimulus. People are going to have money to spend. So if you look at, in the perfect world, if you look at the strategy, now the really good time to raise rates because the economy won't feel the pinch as much it would have felt it 3 months ago.
Yeah, and that's really what investors in the stock market are seeing as well, and they're pulling back out of stocks, as we've all seen today, especially, and back in. And while looking at these yields, they're looking attractive as long-term investment. So that's kind of what we're seeing in the mortgage industry. Freddie Mac has the weekly survey, 30-year fixed at 2.97%, the 15-year at 2.34%. Still a deal.
Still a deal.
Great
Still
rates.
A deal. Still a deal.
Depending on your scenario, and if you feel like you missed out, there's no reason you shouldn't just check. There's going to be plenty of other reasons to refinance. Now, you talked about how people sitting on the sidelines, and some people just don't know when it makes sense. Last year gave opportunities for people. We had people that were refinancing last year in February and March that refinanced later in the year. The opportunities were just so in your face and so evident of the benefits there that it made sense to so many people. Now it's going to dwindle down. I think you're going to see refinance transactions represent a much smaller percentage of overall transactions. Purchases will continue kind of ticking up, as we'll get to a little bit in the show. But that's really going to be the focus moving forward is how do we balance that, Gordon? How do we balance the affordability with the rates going up? We've discussed many times, like a half a point here means you have to make an extra $200 or $300 a week kind of thing, or a month. And that's really what it's going to come down to. And we're starting to get a lot more people who are looking for purchases, Gordon. What do you tell those people now that were quoted a month ago, 2 months ago, that didn't get their offer accepted, and now a month or two later, now rates are a little bit higher, and that payment, instead of $3,000. Now it's $3,300 for the same exact house.
Well, that's why everything in our business, everything we do is actually timestamped. So if you have an approval or a pre-approval, whatever you have, if you work with a lender, not us, you probably should go back and revisit that, because as of rates go up, your purchasing power will decrease. It's not a significant major change in the marketplace yet, but if the rates continue on an upward trend, still we're at historic lows, anything in the high 2s, low 3s, to me is still a great deal, but it's different than where we were 2 months ago, mid 2s, low 2s, and that can have a substantial difference in your purchasing power, especially when we're in an elevated market already, where home prices are already at the pinnacle. So now we have to kind of revisit or rebalance, go back and look back at your formula to make sure that your qualification is actually still good based upon that number that you are projecting to come into the housing market.
One of the things I believe we're going to see more of, the people are saying, well, we're going to buy here. Now we're thinking about buying elsewhere. I think it will continue to push people to looking out of other metropolitan areas of where they already are. According to Redfin, a record 31% of Redfin users look to move to a different metro area in January, driven by home buyer relocating to affordable areas. That's 30.7% nationwide, up from 25.9% from the year earlier. So we're seeing more and more buyers looking at other areas in the United States. Right now, people are looking, the top cities are Bend, Oregon, Boise, and Charleston. Those places have almost doubled over the last year of amount of people, what they call net inflow from 2020. It's gone up, 1,600 according to Redfin users, now up from 750 last year. Some of the other places of note, these are metro areas with at least 100% year-over-year increase in users looking to move into these cities from last year to this year. Austin, Texas, that's up. That's more than doubled. Bakersfield, Bend, Oregon, Boise, Cape Coral, Florida, Charleston, Dallas, all of these small cities, all of these are affordable cities around the United States. The top 10 metros by net inflow of users and their top origins. Austin coming from San Francisco, Phoenix coming from LA, Vegas coming from LA, Dallas coming from LA, Atlanta coming from New York, Sacramento coming from San Francisco, Miami from New York, Tampa from Orlando, Cape Coral, Florida. All of these are coming from big cities to smaller cities, Gordon. So as rates go higher, you even know a friend, a similar friend of mine, that moved out into Indiana, and because they could keep a good job, they can work from home, but now they're able to buy a house. We're going to continue seeing more of this, I believe, as we see interest rates go up. Is there a play on this in any way as an investor?
I mean, those are what we call the overflow markets. When you look at the Stocktons of this area, the Tracys over there, these are overflow markets. They are a little bit more affordable than the basic Bay Area, but as you start to reach out from your core, meaning out to the valleys, you are going to see cheaper pricing. But as the demand grows and the boundaries start to stretch, you're finding those areas start to outpace the actual value. Like, for example, I told you about this guy. We do a lot of things online. Somebody sent me a fourplex today in Sacramento, $925,000 for a fourplex. The rent's are $4,000. It makes no economic sense. I guess maybe the seller's trying to take advantage of the situation, but why would anybody in their right mind spend $925,000 for fourplex, only generating $4,000 worth of rent? The economics aren't there, and this is when the real estate starts to tumble. When people start making bad decisions based on frenzies or based on what the other people are doing, and these are all the same that we talk about. The outlying areas are the first areas that run past value, and they're also the first areas that fall, and they're the first areas that fall the hardest.
It's an interesting scenario because it's not just the price that they're looking at; it's the rents. You're also looking at higher rents. We're in that trend where we've seen record rents in places that normally wouldn't see, $4,000 in rent on a $925,000 quad. And what's the norm? That's what you have to play the game. You have to run your numbers off. We had a client that backed off of a property because we didn't quite convince him, but we said, you're buying this property based on current rents that are at the highest they've ever been, and that's what you're basing the value off this property. He backed out of the deal. And he's glad he did now.
And you that can happen, and that will happen in the market where we were, where everything going to asking price or way beyond, and you buy a property, and let's say it's an investment property, and you're getting maximum rents. Everything is at full throttle. So you buy it, and then rents start to fall as those people decide to relocate because they can get a better unit or a similar unit for 20 or 30% less. people will relocate to a lower unit. Now you have a vacancy. Now you can't re-rent that unit with the higher projection of rent that you did in your formula. And that's where you can start to have a struggle as far as affordability, as far as keeping that property alive. So a lot of times these are all things that you have to consider. When everything is good, all's good, but everything is not so good until there's a problem. When you start to realize these problems, then you see the market kind of start to overreact, and then you start to see the foreclosures and the 30-day delinquencies, the 60-day delinquencies, the 90-day delinquencies start to rise. And that's where you see the market starts to ease by itself.
Which needs to happen. We already agree on that. We're getting messages from realtors and other kind of posts on the internet. Real estate agents are basically urging their homeowners to sell. They're saying this is the time to sell. A lot of people are missing out on the best market now by waiting. The supply of homes for sale settled at an unprecedented 1.9 months in January, according to the National Association of Realtors, with a median home price setting a record at $303,900 in January of 2021. It's a 14.1 increase compared to the 12 months earlier. And what's interesting too is several years ago, I'm going to go back to 2015, maybe 2016. One of the guests that we had on the show, realtor, in fact, he's being on tonight, Tony Bruno. I was talking to him about people that were just buying any property. It's kind of what it feels like. It really feels like that today. They're buying and sellers are seeing that as the opportunity to sell. One of the notes from a realtor here says, a house needs to be in good condition, not great. Her clients ask what it would take to get the top dollar without saying renovating the kitchen. She replies that they simply need to declutter, clean the carpets, and maybe repaint the walls. In the past, you'd have to do almost everything. You'd have to spend, a pretty penny to get that house to top dollar. Now we're seeing sellers not only asking a high price, not giving concessions, but they're not giving you the best quality product.
Well, everything is timestamped. Same thing if you look at the new home market, you start looking to the builders. They give no concessions. As a matter of fact, we just did a transaction. They will give front landscape, but they give no landscaping at all on a $2 million plus property, 6,500 square feet lots. But this is the sign of the times, and when the market is running that way, everybody try to profits.
It's time as a buyer and a seller to kind of reevaluate what you're doing. These are some of the first signs. It's not they're indicators, but we don't know exactly which way they're going. We'll be back after this break on AM 1220 KDOW.
Questions about real estate? Call the program 800-516-1220. Now, back to the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Always welcome to call the show, 800-516-1220, 800-516-1220. Worth mentioning, we have a guest on in the next segment, Tony Bruno from Coldwell Banker. He's a longtime Bay Area resident, longtime guest on the show. We're going to get an update on activity here in the Bay Area. We're going to start getting back more guests now that COVID's kind of, people are more comfortable with, getting out and doing things. With that said, we were talking about rates last segment, Gordon, and, it's worth doing a comparison. People are going to hear that mortgage rates are as high as they've been since last year, February last year, but they're really talking about the yield. Mortgage rates are still a half a point lower than they were last year at the same time.
Once again, you're saying the same thing. Rates, the cost of the rates. Cost of rates.
But rates, let's just say rates. The average rate, we are allowed to say that. The average rate, according to Freddie Mac, was last year a half a point higher than it is today. So if you were off the map for a whole year, you still can benefit from a refinance. They just hit a low. They're still low. There's still benefit to a lot of people out there. Some of the other reasons to refinance, and you're going to fill in the blanks when I don't hit them, a lot of people are taking cash out, Gordon. A lot of people are taking cash out of investments, buying more investments. We've seen one investor who has 10 properties. He had 5 free and clear. He's taking out money to buy more investment. Then you and I had that whole argument about why did he buy that?
Buy that specific property.
I can't use the word that I
yeah.
really used.
Right.
And then you start looking at the rents that he was getting and the rate of return on the investment, and you're like, that's why he bought the property. But he's continually adding to his portfolio. So there's another reason to take to do a refinance: removing somebody from title or adding someone to title, changing your term, getting out of an ARM, maybe your credit improved and you can get out of an FHA loan or any kind of MI. mortgage insurance. Some of those. Any other reasons? Maybe
Well,
divorce.
I talked to an investor today. He wants to take some cash out. He wants to muster up some cash because he believes the market's going to get hit, and he wants to have his money ready so he can take advantage of some of the downturns of the market, the opportunity that
get a low rate
does
here,
present.
get a higher rate of return over here.
So a lot of times is people are astute about what they do. People that have money know how to handle money, manage money, make better money management decisions, and that's what a lot of people have been doing. Is we do a lot of cash out refis. A lot of people are shortening terms, going from 30-year fix to 20-year fix or 15-year fix, trying to pay those mortgages off swifter. As we talked on the show, we were doing an amortization schedule the other day, and we find the lower rates, the faster you actually pay into your mortgage balance and actually pay your note down a lot quicker because you're actually paying a lot less interest. So a lot of different things happen when rates are low. There's a lot of flexibility, a lot of options. When rate starts to go up, people really start to drag, and that's where we're going to see some kind of turbulence come into the market.
I already think it started. It's definitely volatile. The 10-year yield has gone up significantly over the last several weeks. That is a sign not just for mortgage rates, but for the economy and the confidence that a lot of investors have with the economy coming out of the pandemic as fast as they might think it is going to come. We're still going to have some fallout. And a lot of people try to figure out actually how to regain or re-enter into the market or the workplace. We are still seeing, some high unemployment that we'd like to see get a little bit lower. And it's really this is the year that's going to shake out. It's not like we didn't predict this, Gordon. We knew there was going to be some volatility. We know that there's going to be some ups and downs in the market and in interest rates. We knew based on some of the predictions by places like CoreLogic, the National Association of Realtors, home builders, and so on, that rates will be higher at the end of the year. But they have to go up before they average out. So they will probably average out at the end of the year in the low threes like we kind of are getting to right now, although Freddie Mac has it at 2.97% trending upward. You can always call the show, 800-516-1220, 800-516-1220, or email the show, Tony or Gordon at BayAreaLoanSource.com. Pending home sales. They hit their fifth straight loss. January marked the fifth straight month that the National Association of Realtors reported a decline in pending home sales. It's down 2.8% from December. Pending home sales fell in January because there's simply not enough homes to match the demand on the market, said Lawrence Yun. He's the National Association of Realtors chief economist. Just not enough inventory. Right. So we would actually have really good sales if we had the inventory. And then you have realtors, obviously. I mean, it's the same. I get the phone calls. You want to sell your house? When you sell your house? I get them all the time. You get them as an investor. Every investor that has a loan out there has probably had somebody calling them saying, will you sell your house? There's just not an inventory out there, but we have high demand. So we would see those pending home sales numbers go up higher.
Yeah, absolutely. If you look at the marketplace, we always talk about laws of supply, laws of demand. The more supply, of course, the lower the prices, the higher demand, the higher the prices. So they kind of work hand in hand, and we've for many years now, the last 2 or 3 years, we've had limited supply in the marketplace, which has actually continued to fuel those property appreciations. Simply because the more people are bidding for a property, we get the outbidders, you get the multiple offers, and the market's been really had a luxury of those things. When the market changes, then we'll actually see how the market actually rebalances itself to make sure that we don't get these big, massive amount of properties coming to the market, massive price reductions, massive leading to almost the economic crash that we're not looking for. Hopefully the market is prepared because we went into what we call qualified mortgages. Most people that have mortgage today are qualified. As we come out of the pandemic and people now are making money, traditional home, people going back to work, hopefully the economy will stimulate along with the marketplace.
It's a pretty big bet, though, for investors to basically say, we think the economy is going to be right back on track, knowing that they have support, stimulus from not only stimulus, but bond buying, purchasing from the Fed moving forward. So they're putting a big bet and a big step forward that we will be able to sustain these higher interest rates, yields, that is. Meanwhile, the Fed could keep their rates low as long as they want, and just kind of sit back and see what happens, because right now it's kind of out of their hands.
Well, the
investors are taking over.
One of the things we always talk about, too, from the economic standpoint, in order to lower rates, you have to raise rates. So sometimes the market has to go up in order to make a change to be able to come the market back down in case there's some more turbulence ahead. So a lot of different dynamics going on. I think Janet Yellen is going to do a great job in that Fed chief job. I think she's very experienced, and I think she'll be a whirlwind for the market in the Biden administration. So as we kind of look forward to 2021, I'm actually still bullish on the marketplace. I think we have have to make some moves. Things have to change. You can't keep things stagnant in one direction. The market makes money on changes. Even if you look at the stock market right now, a lot of the in-home stocks are beginning to trade places. We're going back into the traditional stocks. You start to see rise. The cruise ship companies, the airlines begin to see some increase in appreciation in stock prices, where a lot of the companies that took over, everything that benefited pandemic, you're starting to see those things slow down. So it's a balancing, as I call it, in the economy, and I'm looking forward to it.
It does present itself interesting scenarios for investors and buyers out there. We wanted to hit an email real quick. This was from Surrey in San Francisco. There are still a lot of people out there looking. As we know, the demand is pretty high. My husband and I are looking in the East Bay to buy a single family property. We have 5% down and could get up to 20% with a gift from my parents. What are the biggest differences between 5% and 20% down? Well, obviously, everybody hears the 20% down. You avoid mortgage insurance. That's the big one. Mortgage insurance, though, has come down quite a bit, Gordon, recently, especially with higher credit scores. So your mortgage insurance on a traditional loan, and in this case, in the immediate Bay Area in San Francisco, she said, East Bay, is $822,000. So you can do 5% down with $822. Your mortgage insurance isn't going to be that much like it would have been $300 or $400 several years ago. It's going to be much less, assuming the good credit score. The other thing too is your rate. You can build the mortgage insurance into your rate. If you do 5% down, you are going to have what they call impound. So that means more money at closing. So your property taxes and your homeowner's insurance are included. And then also you might be obligated to your parents if you have to borrow the 20%.
And you have a higher payment at the end of the day.
And you have a higher payment. So we'll come back after this break. We have a good guest, Tony Bruno from Coldwell Banker. He'll be on after this break. I'm Tony Mendez. That's Gordon Hines. It's the Real Estate Report on AM 1220 KDOW. You're also welcome to call the show 800-516-1220 or email Tony@BayAreaLoanSource.com. We'll be right back.
Phone lines are open on the Real Estate Report. 800-516-1220. That's 800-516-1220.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
You can always reach us, 800-516-1220, 800-516-1220, or you can email the show, Tony@BayAreaLoanSource.com to get your questions on the air. On occasion, we have a really good guest on. Yes, we do know some really good realtors. We happen to have Tony Bruno. He's been a long-time guest on the show. He's with Coldwell Banker. Are you with us?
I am.
Fantastic. Tony works over in the primarily in the East Bay. I know you've spread out over the years because you've been here for so long. You're up to almost 30 years in the East Bay.
Actually, 32 years.
Wow. I'm sure you've seen the ups and downs. Where would you put this kind of market right now on a scale of? I don't like using the word hot, or just hot with many T's, but as a seller right now, it's got to be just, crazy to think that your house value has gone up even higher than it was in 2007.
It's a very, very strong seller's market. I thought there might have been a bit of a correction with the COVID, but it's just not slowed down at all.
Now, we've been talking about inventory over and over and over. In the Fremont, Hayward, Milpitas, all that area, you're looking at a shortage, significant shortage. Where are you as far as how many houses are listed right now?
Unfortunately, I didn't pull up that stat, but I think Fremont total units, condos, townhouses, and homes, it's probably around 100, 120 today. And Fremont's a huge city. That's virtually no inventory.
And we're definitely, what we want to talk about at some point is everyone's getting in bidding wars, right? And I don't know if you remember this conversation you and I had on the air about how I thought people were just jumping into almost any property, right? Because I think it was probably 2014, 15, or 16. And you basically said, no, people are going to buy these properties because they know what the values are going to do. But now we're starting to see realtors come out and say, you don't really have to fix up your house to sell it. You're still going to get top dollar. Are you seeing that kind of phenomenon right now?
We are. Yeah. Yep. And
so I would base it.
Go ahead.
No, it's all you.
Sellers that do improve their homes, a month later they drive by, the new owners are gutting everything they put in. So I always encourage my sellers, keep it clean, but keep your money in the bank.
Yeah, that's all. That would be. I'm selling a house this year, and I'm going through the whole motions of getting a realtor to come in and kind of judge, what it would be if I sold it as is, or if I put some improvements into it. And, but I'm not, I don't know how much I'm going to spend to do that. And I don't know if it's worth it. If I make $2 or $3 grand on it, I probably won't do it. But if I can make 20, 30, 40, 50 grand and get more money out of it by putting, just doing the standard upgrades, I'm going to do that. There's no doubt. So that's one of the things that I think buyers should be looking at is that I don't know if I want to pay extra for something that's fixed up because it might not be something I like. But we are going to come back, Tony, and we're going to talk about winning a bidding war in 2021. That's really the big topic. We have a nice long segment and we can talk about this. There's kind of a checklist that came out from kind of a consortium of realtors, and they said this is what you need to consider when putting an offer on a home and getting it accepted. You're the expert. We're going to come back and talk to you. I'm Tony Mendez. That's Gordon Hines. We have Tony Bruno on as the guest. You can always call the show 800-516-1220 or email the show Tony or Gordon at BayAreaLoanSource.com. We'll be right back after this break.
Got a question? Run it past these guys. 800-516-1220. It's the Real Estate Report with Tony Mendez and Gordon Hines on AM 1220 KDOW.
Going back into the Real Estate Report, I'm Tony Mendez.
And I'm Gordon Hines.
We have a great guest on, Tony Bruno from Coldwell Banker. He was in the last segment. We were talking about inventory, and in a city that's as large, how many people are in Fremont? It's like 1 million, something like that?
Oh, no, we're probably about 280,000 population.
Okay, it feels like 1 million when I go there. But you don't have 100 and something houses listed for sale right now. That includes condos and townhouses and single family. Inventory has been driving, we have a demand. That it's kind of a hard number to really quantify, but there's more demand than there is for properties for sale. And it's putting a lot of people in bidding war situations. As a realtor, as somebody who's been in the business for so long, 32 years, you've seen the ups and downs. You've seen all of the trends and the nuances that go into getting your, an offer accepted. We came up with this list of some of the things that, in order, number 1 to number 9, of what to do to get your offer accepted. I would like some opinion on some of these. Consider a condo over a single family home. I know Fremont has, and a lot of the Bay Area cities have condos, and they're lower priced. What would you tell a buyer to buy a condo instead of single family just to get into real estate?
They're being priced out of the single family home market, and they have to choose a condo or a townhouse. It's just the facts of life right now. And
are we seeing enough inventory for that, though? Can you just flip a switch and say, I'm going to buy this condo now because I can't buy this house?
Yeah, and exactly. It's every segment of the market is hot, not just the houses, but the condos and townhouses as well. Unfortunately, we're seeing these HOA dues in the condos hitting $500-$600 a month now. So that hurts the buyer's buying power.
It sure does. We had one just recently. It was $1,060. It was a condo in San Francisco, and I think I calculated that out to $220,000 in purchase price somewhere else if that didn't have an HOA. That's got to be a big distraction. Not only that, condo association dues rarely go down, and nope. they generally just keep going up, as well as your property tax. Number 2, if you can't waive contingencies, sweeten it to the seller. Now, everyone's heard, and Gordon, especially you've done a lot of real estate as well. Contingencies is somewhat of a protection for buyers. It eases their, I'm going in contract, but if for any reason I can back out, loan contingency, inspection contingency, appraisal contingency. Do you have to waive all these contingencies, Tony, to get your offer accepted?
If they have a multiple offer situation, absolutely. And it's very scary for a first-time buyer to do that. It's, they're basically putting their deposit at risk.
That brought up another one right here where it said, consider releasing your earnest money early, where they're basically saying, I'm going to give you this money, but in 10 days, if we don't close this loan, you get to keep my deposit. Would you ever tell a buyer to do something like that, especially a first-time homeowner?
That would be a very tough suggestion for an agent to make to their buyer. Deposit, you buy a $1 million property, it's a $30,000 deposit on the line. Sure, if you go in non-contingent, it becomes non-refundable, right? I guess if a buyer were that desperate, they could try that.
Would it work?
Pardon?
Would it work? Would it entice the seller to say, yeah, I'll take your offer?
If that seller's out looking to buy another property, they might be tight on funds. if they can get that $30,000 deposit and use it on their next home for their deposit, it might help them secure their next house. But again,
that's
buying and selling at the same time are really a real challenge now as well.
That's something that we see on our side a lot, Gordon. You know that buying and selling, because you own two houses at the same time. And, you know, with the occupancy rules, and they really check on mortgage fraud of, you know, keeping an old property as a rental or buying a new property as a rental. That's been a little harder on our end, and they check up on that stuff. So it gets a little harder to do that scenario. But you are seeing, Tony, people buying properties contingent on the sale of their old property, because, I mean, from my point of view, I'm selling a property in a very hot market. I know it's going to sell, and that seller that I'm buying from should also know that my house will sell. Why would they not look at that? Why would they look down on that?
Again, if they have multiple offers and you have even a hint of a contingency on the close of escrow on your house, that's going to hinder your offer being accepted.
Another suggestion that was made, number 3, was to be open to making offers sight unseen. How many offers are you? And I know you do both listings and buyer agent. How many offers are you seeing sight unseen?
Well, you recall we did one in Brentwood a couple of years back. They were getting beat out. They hadn't seen the house, and says, "Let's just write it. Let's just see if we can get it accepted." And they did. They didn't see the house until we were doing the inspections about a week later. Fortunately, they fell in love with the house. They're still there, and they're actually putting in a swimming pool. So it works, but that's a scary thing to do. As a listing agent, if I know the buyer's not seeing the house, I'm going to be reluctant to have my seller accept that offer.
Okay, that's interesting advice. But that also protects you. You don't want to get in a situation where that backfires on you, right, Gordon? You've experienced this many times where, not many times, but you've had this happen where a buyer gets into a situation sight unseen, but they don't like the house. They just back out, and that puts a lot of strain on a listing agent and the seller. One of the other suggestions here was to be offer to pay some of the seller costs. We know a lot of people are getting into offers and basically saying, we're going to pay you to stay in the house for an extra 30 days. Seller rent back, right? When you combine all of these things,
seeing a free rent back is not an uncommon thing. I had a buyer that was really thinking outside the box a couple years back, and they wrote an offer. $5,000 above their offer went to the seller for the seller's moving expenses.
Okay. So you start thinking about combining all of these things together. Are you looking at a winning strategy here? You know, putting in your best offer, you know, looking at what the average over asking price percentage is or to compare to sales price and putting a little bit more on top of that. Waive contingencies, be open to sight unseen, and then choosing an agent that's willing to communicate. One of the things we're seeing a lot more often and we're doing, and that's contacting the listing agent before they even call us. Having that communication is really important as well, I'm sure.
And I, as a listing agent, appreciate when the lender reaches out to me to tell me how well qualified the buyer is that's looking at my property. That goes a long way for me.
Ultimately, is the highest price always going to win?
9 times out of 10, yes.
Yep. So putting your best foot forward is the way to do it, and try to be as creative as possible. Gordon, any last thoughts on that before we let Tony go?
Well, you know, all these things, Tony, I think we can all agree is great in a seller's market. I think once the pendulum starts to swing to a buyer's market, a lot of these things kind of actually go out the window, because if all these are features and benefits to the seller and seller only, buyers a lot of times have to put themselves at risk just to get themselves positioned to buy the property. And as we see in the marketplace right now, we do see a lot of that because people want properties.
Tony, we appreciate you being on the air. You can always reach out to Tony Bruno at tonybruno.com. That's still your website?
It is.
That's tonybruno.com. Thanks for joining us today. We appreciate all your insight. We'll have you back on as soon as we can. And Gordon, any last thoughts?
Great to hear you, Tony. Good to see you still doing well. And until next time.
You're welcome.
Alrighty.
You can see it's a very interesting market. You always want to get the best kind of realtor that you can, a professional, somebody who's been in the market a long time, has seen the ups and downs, and really can put a good offer to you. These are some really good points, but you still can't get over. In a seller's market, you got to put your best foot forward. You got to make that offer. We're going to talk about a little bit more of that when we come back after the break. About how long is that going to last? How far can that snowball continue rolling? We'll be right back. I'm Tony Mendes. That's Gordon Hines. It's a Real Estate Report on AM 1220 KDOW.
Tony and Gordon are taking your calls at 800-516-1220. It's the Real Estate Report on AM 1220 KDOW.
Grass can be greener on the other side, but it doesn't always work out that way. I'm Tony Mendes. That's Gordon Hines. It's the Real Estate Report on AM 1220 KDOW. We had somebody call us the other day, and they thought the grass was greener on the other side, and they jumped in on a jumbo loan with a lender. Not a lender, I'm sorry, a bank. A large bank everyone knows the name of. And they got about 20 days into a 30-day escrow, and they called me up and said, how can we get out of this deal and get a new one? Because the lender is not going to close their loan because they had deposits in their bank that were unsourceable. They weren't even using that for their down payment or their earnest money or any asset reserves, but the lender still decided that they wanted to source that money, and they can't source it because it came out of the country. That's a big problem with these lenders. They can still throw around some decent rates, and they can look attractive, but if you can't get it, it doesn't mean anything.
Yeah, when it's anything, most of the time you get outside the Fannie Mae, Freddie Mac guidelines, and you get into the jumbo loans. Investors kind of write their own paper, write their own rules. So regardless how reasonable or unreasonable it might sound, if you want that loan, you have to acquiesce and either deliver, or the loan's going to go away, like in this person's particular situation. So you got to know who you're dealing with, understand all the pitfalls, ups and downs, cover these things up front. Don't put yourself in a box. Don't find yourself 20 days into an escrow and a 30-day with a non-refundable deposit and can't perform, and you're going to see that money go out the window. You
imagine if you're 20 days, this person's 20 days into their transaction, they've gone beyond their contingency periods. If they had them, is he going to lose his deposit?
Well, it's hard to lose a deposit. I mean, actually, in order to lose a deposit, I had to actually go to court to lose a deposit. And you go to shit out, you can give some of away, but just, the title company's not going to just turn the deposit over to the seller unless those were instructions up front. But if it's just a deposit, you can fight about it. You can negotiate, give away half. A lot of things you can do if you have good representation.
What this story means is that you really need to get a good pre-approval. We have this commercial that's on. It says, "Hey, get a good pre-approval from us." That's what we do. That's what professional loan officers do. Lenders and banks and brokers, they give you real approval letters. I would expect nothing less if I'm walking in to put an offer in, and that's what you really need to do. That's the other part of winning a bidding war in 2021 on a property, is to get a real pre-approval, not just a piece of paper, because you need someone to go through and say, I saw those deposits. That's not going to work. Let's not show those assets. We don't need them. And it could have been as simple as that. Meanwhile, this person not only could lose their deposit, which you said probably won't happen, because the seller's sitting back and they're like, you know what? I got another 30 days. I can sell this property for probably $20,000, $30,000 more. That's how fast everything is going up. But you need to have that professional representation, Gordon. You can't say that enough, especially going into an offer.
Yeah, I've seen bad pre-approvals come out from lenders or loan officers that makes no sense, that were never validated. They just wrote a piece of paper, buyers approved. The seller, of course, and the seller and the listing agent make a decision based upon that piece of paper. And at the end of the day, that piece of paper is void or avoidable, and it kind of really puts everybody in a tizzy. That's the reason why when we do a pre-approval, we go through all the I's and dot all the I's and cross all the T's, because we know there are other people relying on our accuracy and our lack of negligence when we're delivering a document saying you actually pre-approved to buy a house at $500,000 with 5% down.
Makes a ton of sense. We're still seeing a lot of people, we talked about mortgage rates already. They have bipped up a little bit, but it's on top of another week of increases on top of another week of increases. So rates have gone up almost to 3%, 2.97%, according to Freddie Mac's weekly survey.
But even though rates have gone up, we're still half a point below where we were 12 months ago. So I think this is right around the pandemic started, right around the end of February. So the pandemic looks like it's winding down right around the end of February, if we talked earlier. So as we kind of, once again, balance through this equation, that's what it is. It's a balance. We're going to find ourselves, I think, in good position. Don't panic. Just kind of keep working with the professionals. That's what we always recommend. And I think if you continue in that formula, you can get good results.
And people, I mean, as time goes on too, there's a lot of reasons to, reevaluate your portfolio. And we've actually seen people take higher rates to do the things they need to accomplish, including cash out, paying off a bunch of debt, fixing their credit, and then refinancing, getting rid of mortgage insurance. These are the things and the scenarios that we enjoy really putting together for people. It's meant a lot to me over the last, we've been on the air for 11 years. I've been doing this in the Bay Area for 16 years. I've been in finance for over 20 years. I enjoy doing this. This is what I love, the numbers.
Right.
I love helping the people. I love having it make sense. And you put all of the experience together, and it gives you that professional atmosphere that you really are looking for. And we appreciate all the people who are a part of our show, the people who contribute to the show with the emails and the calls that we get. Again, our website's BayAreaLoanSource.com. It's BayAreaLoanSource.com. We're going to revamp that soon, and that should be a little bit easier. We're going to get an online application as well to make it a little bit easier for some people to get in touch with us and start the process. And besides, everything that we do now is through virtually through email, except the final signatures that you have to do in front of a notary.
Well, that was one of the benefits of COVID. I think a lot of people is actually move everybody up as far as being computer tech, phone savvy. And as these things have become more and more prevalent in the marketplace, this is what we actually deliver. Applications on the phone, applications online. No need to see you. We just need to let you benefit from our great service. That's all.
We appreciate you listening. You're always welcome to chime in on the show, 800-516-1220, 800-516-1220, or shoot us an email, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. There's not much other news out there. Housing inventory continues to be at record lows. That's going to be the driving factor, I believe, Gordon, for the next 6 months, 12 months. But this is that year. I believe we're going to see a shakeout. We're going to see a lot of volatility. But again, if you are in the market for a refinance or a purchase, you need to be ready.
Absolutely.
You need to be ready to pull the trigger when those opportunities present themselves. We'll come back next week. Thanks for joining us. I'm Tony Mendez. That's Gordon Hines. You can always visit our website, BayAreaLoanSource.com. We'll come back next week. This is the Real Estate Report on AM 1220 KDOW.